Okay, so pretty much we're going to be going over market structure, time frame, correlation, and a couple other things. So pretty much, you have to kind of determine what type of trading style works for you best. You know, that's all through obviously backtesting your strategy and looking at your history. What I mean by history, I mean your trade history. Of course, you want to try out all strategies first. I don't really recommend scalping. Scalping is something I don't do too much anymore, but I do recommend trying out either intraday trading or swing trading. So you want to test both of these out, see which one works for you best, which one are you most profitable on. If you're better off being a day trader, which is going to be a lot harder for you to do in the beginning, especially in the beginning, because you're not going to see as many opportunities as you would later on down the line. So I definitely recommend starting out trying to swing trade. So overall, like I said before, if you're going to be swing trading, then you're going to be using time frames like the daily. But, you have to keep two things in mind, right? Your higher time frame would be H4. Your smaller time frames would be H1 and M30, right? And you can either make an entry on the time frame H1 or M30. So overall, you're going to be using your higher time frames for direction, right? And one last thing, obviously, if you're intraday trading, if you're day trading, your higher time frame would be the hour. Then M15 and M5 would be your smaller time frames for your entries as well. So you got to keep one thing in mind. If you're intraday trading or you're day trading, then you'll also have to keep in mind what does market structure look like for the 4-hour time frame, because each time frame has its own market structure. So your higher time frames, being the 4-hour and the hour, are mainly going to be used for direction. What do I mean by direction? I mean if it's going bullish or if the market's going bearish. It's as simple as that. So each time frame has its own market structure. So H4, let's say the market's uptrending, right? And we're currently at this point right here, right? The hour time frame, and let's say it starts retracing, right? The market's retracing. Overall, it's still at an uptrend. The market's retracing to either form a higher low point and retest the previous broken area, whatever the case may be. But on the hour time frame, right? Let's say I'm going to draw this out on the hour right here. It's going to look like this, right? So what's happening here is what happened right here, right? A whole uptrend. But on the 4-hour time frame, you're mainly just going to see a bunch of bullish candles. There could be some bearish candles there, but it's mainly going to be a bunch of bullish candles, right? But you see an entire trend here. Okay, so when the market starts retracing, pulling back, right, to form a higher low point for the hour, what you're going to see is probably some sort of a retest, a double top or something, but you're going to see a break of structure and you're going to see a change in trend within the hour time frame. So what's happening right now, I'm going to erase this. What's happening right now here is currently the market counter trending, right? So that's what's happening here. So if you're day trading, you have to keep in mind, right? If you're catching these counter trends, right, you're selling here, right? You have to keep in mind the market is still overall uptrending based off the 4-hour time frame. Okay, so now what do I mean by breaks of structure, right? So we've already identified the market is counter trending, right? So we've already identified that what happened here is the current trend, the right trend to trade, right? This is why I don't trade these counter trends, because the market could come back at you at any point, right? Let's say we found an area of support right here, okay? What you're going to see is normally the market starting to consolidate on the lower time frames, because of course there's 4 H1 candles in one 4-hour candle. So normally you're going to see the market consolidate in these areas, right? So you have to keep in mind, once you see a bullish candle, right, or a bullish engulfing, let's say this is a bearish candle here, and then we have a bullish engulfing candlestick here, right? Most of the time, what that's going to look like on the smaller time frames, right? Let's say here's the area of support. That's going to look probably something like this, right? Let me undo that actually. So that's probably going to look something like this, right? That's what the bullish engulfing is most likely going to look like on the smaller time frames. So once the market broke this counter trend, right, forming a higher high, right? So here we have lower high, lower low, lower high, a low, and then a break. So this being a higher high. That's when you would pull out your fibs. Your point A would be here, your point B would be here. Then you wait for the market to retrace. Once it starts retracing and it finds an area of support and has either an engulfing or you see a continuation of the uptrend on the lower time frames, then you can enter on the buy, and it'll pretty much look like you're entering on a wick here based off of the 4-hour time frame and a continuation of the trend. So that's what I mean by break of structure on the smaller time frames, right? So this would be the BOS, the break of structure right here, the break of the previous lower high forming a higher high. It's obviously a break because this high is higher than that high, changing the trend. I'm just trying to simplify this as much as possible so you can understand this as best as possible. So that's pretty much what I mean by overall counter trends and breaks of structure. So normally you want to be trading the right trend. You normally want to be buying in an uptrend, because if you're trading the lower time frames, then it can be dangerous because the market can reverse at you at any point, right? Let's say you're taking sells all throughout here, right? The market's still overall uptrending. So that's why I do recommend you don't counter trend. But overall, I felt like this was fairly simple to understand. Hopefully you did understand that. Now, it's the same concept goes for H1 and M15, except you just have to keep in mind where you are at H4, right? So then it's the same exact concept, right? I'm going to repeat it one more time. H4 is your higher time frame. H1 is your higher time frame. These time frames are going to be used for overall direction, if the market's going up or if the market's coming down, if the market's going to go bullish or if the market's going to go bearish, right? These time frames, your smaller time frames, are going to be used for market structure. Like I said before, you're going to normally see bullish candles, right? But it's going to be a whole trend on the lower time frame. So what you see here, which is a bunch of bullish candles, is going to be a whole trend on the lower time frames, right? So that's what that is. So it's as simple as that. You just have to backtest this as much as possible and pretty much learn for yourself as well. Like I said, trading is all about self-development. So overall, hopefully this video did help out a little bit, and I will be talking to you guys in the next video.